Hi class, I want to welcome everyone to week 8. Okay, for today's lesson I'd like to go over long-term assets. Okay, let's start the first one. This first one says here, Rick Castillo Company incurs the following expenditures. He just bought a brand new truck. Got a cash price, accident insurance, sales tax, motor license vehicle fees, painting and lettering. So here we want to find the cost of the truck. Well, you want to start the first one. The first one that will go on the cost of the truck will be the cash price. Okay? So we have cash price here of $30,000. So now you want to add the sales tax, which is $2,100. You also want to add the painting and lettering, which is $400. Okay, so total price of that truck you would put here $32,500. Now the motor vehicle license will not go into it $100 because that's going to be a recurring fee. Okay. These costs are the costs you need to acquire it and prepare for usage. Okay. Let's continue on to the next one. Number 2. It's your Flattery Company had the following 2 transactions related to its delivery truck. First one, number 1. It says you paid $45 for an oil change. Now, an oil change is just a regular ongoing expense. So you want to debit maintenance and repairs expense for the $45. And then the account credit would be cash because, well, you use cash to pay for it. Now number 2. Number 2 says you paid $400 to install a special gear unit which increases the operating efficiency of the truck. Now this is capital expenditure because it was a major cost and extended the life of its useful life of the truck. And this one increased the operating efficiency. So you actually want to debit truck for $400. And then you want to credit, well, you need to pay for it cash. Now, it would go to the asset because this is not an ongoing recurring expense. It's a one-time expense, and it increased the useful life of the truck. Okay, let's continue on now. And here, number 3 here. Number 3 here says, Rancor Mine Company purchased for $7 million of mine estimated to have 35 million tons of ore, no salvage value. In the first year, 500 million tons of ore are extracted and sold. So first things first, you want to get the depletion cost per unit. Because here, remember, well, natural resources we don't depreciate, we deplete. So you get the depletion cost per unit. You want to start off how much you pay for that mine, which was $7 million. $7 million. Then you want to divide by how many tons of ore you can get out of it. The units of activity, which in this case is 35 million. Okay, so this will be 20 cents per ton. So each ton of ore that comes out of that mine will be 20 cents. Okay. So now the first year, you say you took out 5 million tons of ore. So how much depletion will you have? Well, let's take a look. Again, take the 20 cents. Okay. And you multiply it by the 5 million. Okay, so your depletion for the first year will be $1 million. Now, how would you record that? Well, again, you want debit depletion expense. So remember, with natural resources, they don't depreciate, they deplete. So you want, like I said, debit it for $1 million. And then the account you want to credit would be accumulated depletion for $1 million. All right, let's go next one now here, number 4. Number 4 here says Terry Wade, the new control of Helixson Company, has reviewed the expected useful life and salvage values of select depreciable assets at the beginning of 2014. His findings are: all assets are depreciated with straight line method. Use a calendar year. So here we want to revise the depreciation for each one. Okay, so we start with the first one, the building. Okay. Its book value of the building. Okay, let's take a look at what it is now. Well, it's going to be $686,000. Because the cost was $800,000, but you have accumulated depreciation of $114. So you take the $800,000 minus $114,000, gives you $686,000. And then you want to take out the salvage value, which in this case is $26,000. So the new depreciable cost. Okay, if you take the 686,000 minus 26,000 would be 660,000. Now, how much useful life does it have? The old was 40. The proposed is 50. Well, you've already gone 6 years, so now its remaining useful life will be 44. So divide by 44. Okay. So now if you take 660,000 divided by 44,000, new depreciation will be 15,000. So your value and depreciation now for buildings is going to be 15,000. Right. Now let's do the same thing for the warehouse. The warehouse, again, its book value. Okay. Start at 100,000. The cost accumulated so far is 19,000. So take the 100,000 minus 19,000, leaves you with 81,000. Salvage value here is going to be 6,000. Take out 6,000. So what's depreciable cost? Well, 81,000 minus 6,000 will be 75,000. What's remaining useful life? Well, it was 25. Now the proposed is 20. And you've already depreciated 5 years, so you have 15 years remaining useful life. So if you take the 75,000 divided by 15,000, its new revising depreciation is 5,000. So the depreciation for the warehouse is 5,000. Now, the next part says prepare and to record depreciation on the building in 2014. Well, the end of the years will be December 31st. So you want to debit depreciation expense for $15,000. And then you want to credit accumulated depreciation, except, remember, you gotta be specific, what is it for? So depreciation for building for $15,000. Okay. Now, the next one here says, presented below, select transactions at Rich Company for 2014. Okay. So the first one here says, retired a piece of machinery that purchased on January 1st, 2004. Machine cost $62,000, had a useful life of 10 years with no salvage value. Okay. And now this is for a Rich Company at 2014. So we saw the first one at January 1st. Well, first things first. It says here you want to retire it. Well, if it's fully depreciated, no salvage value, you just want to debit accumulated depreciation. Okay, for equipment for $62,000. And now, because, like I said, you retired it, you want to credit the asset to get it off your books. You credit for how much you bought it for, the cost, which is $62,000. Next one now, at June 30th. At June 30th, it says here, how much depreciation do you have on this computer? Okay, sold a computer purchased on January 1st, 2011. The computer costs $45,000, has a useful life of 5 years with no salvage value. The computer was sold for $14,000. Well, we got to make two entries here. First of all, you sold it June 3rd, so you're going to have partial year depreciation on that, and then we'll record how much you sold it for. Okay, so to record the depreciation, we know we're going to debit depreciation expense. And then credit accumulated depreciation equipment. Okay. Now let's calculate for how much. Well, we know it costs $45,000. Okay. Then you got to multiply by 1/2, because remember it says here 5 years salvage value for the 1 year. 1 divided by 5. And you have to multiply it by 6 divided by 12 because it's for half a year. So the total depreciation you got to record here will be $4,500. Okay, so go back up here, debit depreciation expense for $4,500, and credit accumulated depreciation equipment $4,500. Okay, now it's time to record the sale. Okay, so at June 30th. Okay, first. Okay, so let's see how we're going to do this. Okay, so first of all, right, let's take a look. how much cash did you get for? So June 30th, you want debit cash. It says here you got $14,000 cash. So I'm gonna debit cash for $14,000. Okay, we're good with that one. Now you want to debit how much accumulated depreciation do you have on that so far. Okay, so we're going to debit accumulated depreciation. Remember, we're not trying to increase it now, trying to decrease it. And we decrease it with the debit equipment. Okay. And let's see how much we're going to have here, okay, for this accumulated depreciation equipment. Equal, well, we start the first part. We know it's $45,000. And multiply it by how much time has gone by, times 3 divided by 5. Okay, so that will equal $27,000. Except, don't forget, you also got to add in that $4,500 at June 3rd, so plus $4,500. The total amount of cumulative depreciation you have when you sold it was $31,500. So I'm going to debit accumulated depreciation equipment, $31,500. Let's continue on. Okay. Now you don't have this equipment anymore, so you want to credit equipment for its original cost, which was $45,000. Okay. Now, on this, when you sold this equipment, you actually had a gain on disposal of plant assets. And let's see how we got that gain. It says here you got $14,000. Okay, take $14,000. And you want to subtract how much it was worth at the time. So if you bought it for $45,000, subtract how much cumulative depreciation you have so far on it, which is $31,500. So you actually made a $500 gain on disposal of plant assets. Okay. And because it's a gain, you want to debit it. Okay. So that would be $500. Now, if it was a loss, I would debit it. Okay. Continue on now. At December 31. Since you discarded the truck purchased on January 1st, 2010, the truck cost $33,000, display 6 year useful life, $3,000 salvage value. Okay, so again here, okay, let's see. We know the entry is going to be depreciation expense, and we're going to credit accumulated depreciation equipment. Okay, now let's see for how much. Well, again here, we know the cost is $33,000. Okay. So we take $33,000 minus the salvage value, which is $3,000. So that'll equal $30,000. And the last part, you want to divide by its useful life. So it says here 6 years, so divide by 6. So depreciation here will be $5,000 annually. So to record this depreciation expense, we go back up here. Again, debit depreciation expense for $5,000. Then credit accumulated depreciation equipment for $5,000. And the last part here again, it says, okay, now it says when you discard it. Okay, so again here, December 31. Okay, so now you actually got to make two things. Okay, first of all, again, we're going to debit the accumulated depreciation because we want to get rid of that. So getting rid of the truck. Okay, so debit accumulated depreciation for equipment. Okay. Now, let's see how much it was for. How much accumulated depreciation do we have when we got rid of it? Okay. So we start the first part, okay, which is going to be cost minus salvage value, which we know is just like we did up here. $33,000 minus $3,000 is $30,000. Except to see how much cumulative depreciation we have, you multiply by 5 divided by 6. Okay, so when you got rid of it, you had $25,000 of accumulated depreciation. So you want to debit accumulated depreciation for $25,000. Okay, and remember, to get off our books, you want to credit. So you want to credit equipment for $33,000. Now, by looking at this, I see the equipment was worth $33,000. And when we discard it, we only had total cumulative depreciation of $25,000. So now we got a debit loss on disposal of plant assets. Okay, which would be the difference. Take the $33,000 minus $25,000. You lost $8,000 here. Okay. Let's continue on now. It says on January 1st, Everest Company made the purchase the following 2 machines for use in its production process. Okay, so let's start with the first one. Number 1. You're going to record the purchase on January 1st, 2014 for machine A. Okay, so it says here you bought it for $48,000. You had certain costs for it, expenditure, sales tax, shipping costs. Okay, so now we know we're going to debit equipment. Now you would include all the costs for it except the $100 for oil lubricants because that's an ongoing recurring cost. You're going to have to do that every so often with that vehicle. So you're going to debit equipment for $50,000. And then what do you used to pay for? You just want to credit cash. $50,000. Now we go to part 2. So journal to record its annual depreciation. Well, again here, we know we're going to debit depreciation expense and credit accumulated depreciation equipment. Now let's see for how much. Again, take the $50,000 minus the salvage value, which is $5,000. So the depreciable cost here would be $45,000. And you want to divide by how many years its useful life, which in this case is 5. So divide by 5. So its annual depreciation will be $9,000. So now I'm going to debit here. Debit depreciation expense for $9,000. And credit accumulated depreciation equipment for $9,000. Alright, let's go to the last one now. Alright, the last one here says calculate depreciation expense for machine B, except machine B is going to be different methods. Okay, we start with the first one. First one is straight line. Now remember, straight line is going to be the same each year, regardless of how much you use it. Okay, so do straight line, we start with the first one. What is recorded cost? Well, its recorded cost was $180,000. And the next thing is you want to take out its salvage value, which is $10,000. So now, again, you take the 180 minus 10,000. This will give you my depreciable cost. Okay, now my depreciable cost is going to be $170,000. Okay, and divide by its useful life, which in this case is 4 years. Okay, so if you take the 170 divided by 4 years, you will have $42,500 of annual depreciation for this asset. Now remember, it doesn't matter if you use it or don't use it, you get the same amount. Okay, let's get the next one now. Next one says here, declining balance method. Okay, so we start with the book value at the beginning of the year. Okay, you don't need to take out a salvage value, so you're going to start with $180,000. Now, next part, this we're going to have to calculate what is its annual rate. Well, let's take a look how we can get this. Get the annual rate. Okay, start off with 100%. You would divide by its useful life, which is 4 years. Okay, so that would be 25%. But because declining balance, we double it. So we multiply that by 2. So it's double declining rate is going to be 50%. Okay, so it's right here will be 50%. Okay, the first year is first. We take what's 50% of 180,000, which would be 90,000. And for the first year, our accumulated depreciation will be the same because we only had 1 year, so it's going to be $90,000. Now the next year. Okay, now the book value is not going to be 180, it's going to be 90,000. Because if you take the book value at the beginning of the year 180 minus accumulated depreciation 90,000, give you 90,000. Now our rate will still be 50%. Okay, so now we take 50% of 90,000, which is 45,000. Okay, so our accumulated depreciation now increased. Take the 90,000 plus 45,000, it's 135,000. All right, now we go to the next year. Okay, to get now our book value here, take the 180 minus the 135, leaves you with 45,000. Now our rate is not going to change. That's still going to be 50%. So now we take 50% of 45,000, which is 22,500. Again, you take 22,500 plus the 135,000. That would be 157,500. So now, to get our book value of the last year, take the 180,000 minus the 157,500. You have $22,500. Book value at the end of the year. Raise them 50%, except we can't take 50% off this because remember, we have to have $10,000 left to salvage value. So I know my total here, accumulated depreciation, has to be 170,000. Because if I start at 180 and I have salvage value of 10,000, I know I'm going to depreciate it. It has to be 170,000. So this last year depreciation, I have to plug it in. Okay. So how would I get this? I get that last year depreciation. I take the 170,000. Subtract prior accumulated depreciation, which is 157,500. So this will be $12,500. So this last year depreciation, you plug it in, $12,500. Because I can't take half of 22,500 because then my accumulated depreciation will be higher than 170. And I only want to go up to 170 because I can't. My salvage value has to be at least $10,000. Okay. All right. And the last one. Okay. The last one says here we depreciate units of activity. So again, start with the cost of the asset, which is 180,000. Take out the salvage value, which is 10,000. Now divide by how many units expect to produce. So divide by 125,000 units. Okay. So we know each time I use this, it'll be $1.36 per unit. And to get the annual depreciation for each one, just take $1.36 multiplied by how many units. So with the first one, take $1.36. The first year, 2014, you used it 45,000. Okay, so the first year will be $61,200. And we continue on to the next year. Again, that's not going to change. It's all going to be $1.36. Now, your units, how many you use, that will change. Now it's going to be 35,000. So this will be now 47,600. Go to year 3. Again, $1.36. And multiply by 25,000. Okay, so about 2016 will be 34,000. And then the last year, $1.36. And multiply by 20,000. This would be 27,200. Okay. All right, class. Hope everyone's doing well. As always, if you have any questions, please feel free to call me. All right, everybody, take care.